All right. Well, good morning, everyone. My name is Jonathan Bricker, and I'm the chairman of the Arkansas District Export Council. And I want to welcome you to the fourth and final session of the Export Finance Series. Today's topic is managing currency risk. Currency doesn't have to be the big, scary monster that you might think that it is. There are some real advantages to accepting foreign currencies for both you and your client. Today's webinar is only possible by the support that the DEC has received from the Arkansas Economic Development Commission and Arkansas Manufacturing Solutions. I just want to say thank you to both groups for partnering with us over these last four sessions. Because of your contribution is what made this all possible. Really appreciate you all being here today. I see a lot of the same names that I've seen in the other three, so thank you for your dedication to this series. But for those of you on here that are new and aren't quite sure who the DEC is and what we do, we're a private nonprofit organization that brings together experienced international business people with potential exporters. Each DEC member has been appointed by the U.S. Secretary of Commerce because of their real-world expertise in international trade matters. Now, having said that, we do have people in every different sector with a lot of different companies. So if one of us don't know the answer to something, we will find out someone that does have the answer. So please reach out to us if you have any questions. We are essentially a community of connections, bringing people together. My hope for the day is that you walk away from this webinar with a little bit more confidence in your exporting abilities. If you have a question and you don't really feel comfortable asking it here on the webinar, please reach out to us on our DEC website, which is exportarkansas.org, and we'll be sure to reach out to you with an answer. We really do want to be your strategic partner to help you grow your exports. This morning, I'd like to introduce everyone to your moderator, Rudy Ortiz. Rudy is recently retired from the Arkansas Economic Development Commission, and he's also the previous chairman of the District Export Council. He is the owner of Strategic Business Services, LLC, where he helps companies in a wide variety of international business and exporting needs. He's a certified global business professional, as well as a U.S. Department of Commerce Certified Export and Trade Counselor. And for these reasons and many more, he's the DEC's Education Chair. Michael, I really appreciate you being here with us today and sharing your expertise with us. Rudy, thank you so much for spearheading the webinar. And with that, I'll turn it over to you.
Thank you so much. Well, let me put on my glasses so I can see the fine print. I want to introduce my colleague, Michael Salerno, who, in addition to being an expert in foreign exchange and many other things, is also with the National Association of District Export Councils as the treasurer, no less, of the NADEC, as we call it. Michael is an experienced international banking professional where he manages a diverse portfolio of corporate and correspondent bank customers. He consults with treasury management professionals located throughout the Midwest to help define, create, and implement effective trade finance, global payments, and risk management solutions. Michael specializes in providing foreign exchange and international payment solutions for financial institutions. And there is his contact information, and we'll be providing that at the end as well. And so with that, Michael, let's hear about the foreign exchange and how to
Great. Thank you, Rudy, for that. We'll just go ahead and I'll bring this up here real quick, and hopefully everybody can see my screen. But what I really want to do today is to basically to what Jonathan's point was, is really take away a lot of the fear and simplify the foreign exchange market. I was brought on by First National about 20 years ago to build out our foreign exchange trading platform, and that's evolved in many different ways. But what I would say our success is really just simplifying it, trying to make it as easy and understandable as possible so that it doesn't take a lot of your time and allows you to do what you do best. So with that, we're going to just talk about the market, what it is, We're going to talk about a few different ways to identify exposure, but have a couple case studies just to illustrate how you can, especially in this market, use currency as a way to be more attractive overseas. So the first thing we want to talk about is what is the foreign exchange market? There's four major functions in FX. There's trade, investment, hedging, and speculation. The financial FX market is, extremely liquid and extremely decentralized, meaning that we have all different types of institutions and people trading foreign currency. It is 24 by 5, so we are actually having different trading sessions, so that adds to the liquidity. Obviously, New York opened up, but we have major centers in Tokyo, in Australia, and around the globe, which allows a lot of participants to enter in this market. A lot of the trading volume, though, really does come from speculation, and we'll cover a lot of that here later, but about 90% of the volume really are some of the actual investment firms or other actors in the market trying to actually use it as a way to generate revenue for themselves. And due to this, it is the largest asset class by trading volume. And just to kind of illustrate that further, this shows the equity markets kind of by jurisdiction. So a lot of flow, as you can see, that is coming from London all the way to New York Stock Exchange, all the other different markets. This year, there was a study that came out and said that in 1 year, there was 56 trillion that came out of the equity markets. In 1 day, there was 7 trillion in foreign exchange. So what I really want to say is FX is really everywhere. It's just not traded with banks. It's traded all over the world. It is a major component of trade. Sometimes it's direct and sometimes it's indirect or hidden. But you really have to be aware of what is happening with the currency markets to be effective. So the FX market, we always want to talk about it in two ways. Over the counter, or OTC, is what most exporters are familiar with. This is where bulk of the foreign exchange is actually traded. This is your non-bank providers, it's your banks. It is really where the counterparty that you're trading with is where the risk is. So two individuals, whether it's you and a bank, you and a non-bank, you and another provider, are agreeing to a contract and you are going to settle against each other. The major products that are used are spot transactions, and we'll go into that a little bit more, swaps and forwards. The difference from exchange-traded products, like trading on the SME, is that the counterparty really that you're trading with is the risk is mitigated by the exchange. So as you are funding your side of the settlement of a euro trade, and maybe they're doing dollars, if they don't supply the dollars, there's no counterparty risk because the exchange is going to mitigate that for you and give you your funds back. The other major difference is it's standardized contracts. You could go to your bank and you could buy 1 million euro. On the exchange, it's 100,000 bucks. So, and the tenors on a future are set. So 3, 6, and 9. You can't do 35 days. Usually the exchange is usually speculatory for trading or more of balance sheet hedging, not completely transaction hedging because you can't get a true hedge. And again, spot and swaps are on there. The difference between an FX forward usually means it's OTC. You can do an exact transaction. So you can go out and buy 53,204 euros at a very particular date. With a forward, you would have to stack those contracts. And it doesn't give you a true hedge. So you're either somewhat under-hedged or over-hedged. The bulk of what we'll talk about today, or I should say what we will talk about today, is the over-the-counter market. Okay, so who participates? Commercial banks, central banks, corporates, and investors. So central banks are going to use foreign exchange as a way to build up reserves as part of their policies. Commercial banks are not allowed to go out and speculate in the FX market. They're not going to go out and buy large chunks of another currency or short another currency in the hopes that they're going to generate revenue for their institution. That is actually not allowed anymore. Those arbitrage desks are not there. So commercial banks are actually generating foreign exchange risk or transactions based upon their customers' volumes. Corporations, they're going to generate FX, whether they're multinational or just within the US, from transaction hedging. So they've actually got an exposure in another currency. Maybe they have subsidiaries or assets overseas. So that's going to be more of balance sheet hedging. And then investors. We talk about investors. These are the hedge funds. These are going to be some of the other actors that are out there, or participants that are actually trading foreign currency, taking positions in order to generate revenue. So to set the stage, why deal in foreign exchange? So until recently, there hasn't been a lot of volatility in the market, and most of even the clients we talked today said, we deal in dollars, that's fine, and it's worked for us, and it's a good strategy, we're going to stick with it. So those are the reasons we get. We'll always deal in dollars, and it'll never change. We don't have the internal software or resources to switch our invoicing. Our bank does not offer the product. We have no exposure. Our vendor only wants dollars. I don't have time to learn the currency markets. So on my team, we spend a lot of time when we hear this. So if you are actually importing today, if you are a manufacturer and you are getting inputs from overseas and you continue to purchase those in US dollars, you're overpaying. The dollar has dramatically increased over almost every currency. And now with that US dollar price, your supplier is getting a lot more than they intended. So there's always risk there. Or if you use a US dollar distributor, they're probably padding the foreign exchange. So they're either going to use forwards we're talking about to mitigate their risk, or they're increasing their price by a certain percentage. So when we hear these things, you at least have to be aware of your exposure, especially if you're selling overseas right now with a high US dollar, to understand, is it time to offer in a foreign currency? Is there a time to at least understand your exposure or where the currency markets have come to renegotiate pricing? These are all things that you need to understand. Why deal in foreign exchange? And again, it depends on your viewpoint. We always say active management of your receivables lead to better margins. So most of our clients today are exporting, and they're exporting all over the world, and they've seen a lot of pushback from their buyers. They have competitors that are offering similar products that they have not chosen to go with, but because of the rising dollar and they're have to pay in dollars, and for putting all of the risk management for foreign currency on them, they're starting to look at other suppliers. So hedge a portion of sales, or at least try to negotiate pricing based upon where the market's moved. Take on that foreign currency risk yourselves, or split it between yourselves to make sure that you are continuing to be a good partner, developing those relationships overseas. On the payable side, again, we have to talk about this in today's environment. We've seen a lot of clients starting to ask for dual currency invoices. And we'll show an example of that. They're seeing significant savings because of the way the dollar has appreciated. It's been a really good tool to even enhance relationships. Not only is a supplier still getting, maybe they have a 20% margin and now they're getting a 25% margin, but you're also reducing your cost maybe by 5 to 6%. So taking advantage and being aware of where the market is crucial to run your business, and also making sure that you're maintaining a positive relationship with your suppliers and customers. Pricing flexibility. It enables your clients overseas to compare apples to apples. So we are seeing a lot of requests from our customers that are selling overseas for dual currency invoicing. They want to be able to see, how are they actively managing the FX? Are they hedging? Are they just including a buffer to cover the volatility? They want transparency in pricing, just to be fair. Compete against multinational firms and compete against in-country competitors. So again, this is obviously top of mind. As you're exporting to some places where maybe US dollars is required, so China, Brazil, and some of the other restricted currencies, a US dollar invoice or billing in US dollars makes sense. If it's tied to a commodity that is based in US dollars, it makes sense. But as we are starting to see, particularly in food products and manufactured goods going to Australia and Europe, billing in US dollars with with an appreciating US dollar is becoming very challenging. That strategy is costing sales. It's putting heartburn on relationships. So it's time they're reaching out, figuring out what is a good strategy that is fair for both parties involved. Wanted to share this little survey that came out, and it said key risk factors that went out to CFOs and treasurers of what are going to be the biggest challenges on an organization's earnings over the next 3 years. So obviously competition, customer satisfaction. I think we're all focused on the customer experience. A lot of uncertainty around free trade agreements, interest rates, no surprise to anybody, but then currency volatility. So I think over the last 2 years, we've been really spoiled as you know, U.S. exporters, where interest rates have stayed fairly low and steady. We haven't seen inflation, and there was very little FX volatility in the market. That just changed overnight, and pendulum completely swung the other way. So we've seen a dramatic increase, I believe 382% increase in our exporters actively managing or hedging their foreign exchange risk. Just because before it was not a concern, but with the volatility the way it is, the way the interest rates are going, and we'll show how interest rates will affect your hedging strategy. This has become a focus of small to medium-sized businesses as well as corporations. So what is currency risk? Really what we're looking for is the unexpected change in price. So if you are going to export and your customer's got an invoice or they have an expected price in US dollars, that treasurer or whoever is going to make that payable is waking up every morning and trying to figure out if their currency is euros, how many euros do I have to have aside? Do I need to set aside and understand how it's going to affect my cash flow to pay this US dollar receivable? So that's fluctuating every day. The other issue is that if you're billing in a foreign currency, it could affect your profit margin. If it's unhedged, now you're taking 100% of the risk, and you know that you're getting €1 million, and that was set at a rate months ago at a 20% margin. As that euro and dollar has volatility, your margin's going to increase or decrease. The biggest issue is it creates inconsistencies in a balance sheet. Those gains or losses really can affect your balance sheet, but what we want to focus on is cash flow. Cash flow is going to be the main reason why we want to manage our foreign exchange exposure, especially on a transaction. If you have a counterparty in Europe or Australia, you want to manage that and make sure that your cash flow is protected. That will flow eventually to your balance sheet. But I think we are all aware, just in the current environment, cash is a big component of making sure the business is running efficiently. And we want to make sure that FX isn't the reason that wipes out your cash flow. Okay, so we're going to talk about just some basic products, spot forward, non-deliverable forward, and currency options. Just so we understand kind of the products, the terminology, and how things are quoted. The first one is spot. This is your simple contract. I'm going to buy one currency. I'm going to give you another one. The standard is that if you did a trade today, it would settle in 2 days. Now, with Canada and Mexico, that's next day. I will tell you that most banks and providers now, regardless of currency, are doing next day. You can do a cash trade for today. You can do a next day for just about every currency. It all depends upon time zones. The reason was for 2-day settlement was just positioning your accounts globally. But with electronic trading and online banking and all the other things that have came out, Swift GPI, we can move fast. I can tell you that we have a customer that exports or that purchases from Australia, and that used to take 7 days for that person to actually have those funds available to them, 7 business days. Today with Swift GPI, which is their global payment initiative, when our customer submits that transaction and the Swift message goes out, the beneficiary now has funds within 17 minutes. So the long period of time to settle trades, if you are having issues where your beneficiary is saying they're not getting funds in 2 days or they need to get them faster, something you want to talk to your provider about. You should be able to speed them up, take a little bit of edge off your partner when you're paying them or they're paying you to speed this process up. But a spot transaction, again, it's a simple contract. Normally, as an exporter, your customer is going to initiate the wire on trade day. It's going to be a spot trade. The settlement is going to be a wire. You should have it in 2 business days. You can also settle the spot trade via draft. We obviously don't recommend drafts anymore, just because no one really uses checks other than the US and a little bit of Canada. But you can also do what we would call a low value payment, so an ACH equivalent, SEPA in the Eurozone. So these are just your immediate transactions. These are your standard foreign exchange trades. Now, forward contracts is anything past a spot value, so more than 2 days. So this is an obligation to buy or sell a currency at a future date. The money does not change hands until value date. So this is where we're talking about actually hedging. This is a derivative product. Not all commercial banks will offer this because of Dodd-Frank and other regulations, but this is probably the easiest tool to hedge with. It's extremely accounting friendly, and it really allows you to lock in your profit margin. So this, if you know that you've sent out an invoice and they're going to accept it, $1 million Australian dollars, that's when you would call your bank and say, I want to sell you $1 million Australian dollars on trade date. And you know that maybe your invoices be paid in 90 days. So they can actually lock in a rate to buy $1 million Australian dollars in 90 days from you. That will allow you to then lock in your margin, and you don't have to wake up every day and wondering, did you make or lose money? At that point, you're hedged, and we'll have a case study on this. Currency volatility and movements are irrelevant to you. You're completely hedged. Now, most forwards are used to do transaction hedging, and that's probably the most important. You can use forwards to maybe hedge assets on your balance sheet. So if you do have assets overseas and it actually, that translation over to dollars on your balance sheet causes issues maybe with loan covenants or the value of your company, they can be used for that as well. But we see it very popular or mostly used here in the US to lock in exposures on a transaction, individual transactions. And again, it gives you financial certainty, completely predictable cash flow on that transaction. They're available in most currencies. Any of your liquid currencies, you can lock in a forward, and they're completely customizable. This is why they're used more than futures, because if you have a receivable of $118,014 and it needs to be at 66 days, you can actually give those terms to your bank or provider, and they'll lock it in, and you don't have to worry about being overhedged or unhedged. The one thing that we'll talk about here is that the difference between a spot transaction and a forward is that a forward has points added to it. So when you are actually comparing with your providers on this, there's a spot rate, there are forward points, and then the all-in rate. You always want to, if you're bidding it out to multiple parties, you want to compare the all-in rate, because your bank or provider will take a spread on the spot rate, the forward points, or both. And we'll show you an example of how that's calculated. But what this is really doing, the forward points, is negating the ability of you to, borrow at 1% in the EU right now, invest at 4.5% in the United States, lock in a forward, and take that arbitrage. Those forward points would actually make sure that you would break even, and there is not an arbitrage, better known as the interest rate parity. Forward contracts are fixed dates. So you can have a very particular day where that settles, like December 22nd. But what we find is more popular for exporters is using a window contract. This allows you to have a window to settle. So obviously, as you're getting receivables in, you don't know the exact day that your customer is going to pay you. So if you think 90 days is when it's due, or if you think December 22nd is the day it's due, we always recommend book a window forward for a settlement of December 15th to January 15th. So as long as those funds, those euros or that foreign currency comes within that window, you're guaranteed that rate, and you're guaranteed to get the US dollar amount of the contract. If you did a fixed date and it didn't land on that date, you'd have to do a swap. If it settled outside the window, you would have to do an FX swap. Now, what an FX swap is it just rolls the maturity date either further out or earlier, depending upon your needs. And again, you're going to pay a spread from your provider from that again, and it's going to be based upon the interest rate per forward points. So I always say if you're having receivables, if you never know what's going to happen, use a window contract to build in some flexibility. Another, if you have maybe multiple invoices that are going to go out there and they're smaller, book a window forward for the month. And if you have 6 invoices that are paid, you can do a drawdown. So that a drawdown would be for the full amount of the invoice. You reduce that contract, but you still get that guaranteed rate. It allows you to have a bigger window forward amount, which normally banks then will lower your spread. What I do want to stress is that when you get forward rates, it is not a prediction or a forecast of where the currency is going to go. If we would quote a forward rate out 6 months, that doesn't mean that that's where we think the forward will be valued in 6 months. What we're saying is here's the spot rate. This is the current value today. We've had to add or subtract forward points to ensure that there's not an arbitrage situation. It is no way of predicting where the currency is going to go. The second thing when you're using forwards is that hindsight is 20/20. Once you're locked in, if you're going to sell a piece of machinery and you wanted to sell it for $215 US, and you're locked in at a rate that gets you $215, markets are irrelevant to you. You shouldn't wake up and look at the market and say, oh, if I didn't hedge, I would have made money, or I'm glad I hedged because I would have lost money. No one's going to outguess the market. No one can outpredict the market. So what you're really trying to do with forwards here is bring predictability to your cash flow. You'll get mark-to-markets reports from your bank or your provider. That will tell you the value of that contract. If you had to unwind it, maybe you violated a credit facility, or for whatever reason you want to get out of it, you could take a gain or loss. That's all that is. Telling management that that's the value of your derivatives and where it goes to your financials is one thing. The next thing you should be telling your management is that, hey, we have X amount of exposure to euros, but we're completely hedged. We knew that if we would have done these sales in the US, it was $5 million US. We billed in euro, but you've used forwards, and it's $5 million. All the FX noise should be gone away. A non-deliverable forward. These become very popular as of late, just because we're starting to see more of the restricted currencies like China and Brazil see a little bit more volatility. Sales are still strong there. How do you hedge against this? So these are contracts that are net settled on value day. The settlement really is the difference between the contract rate and the spot rate. This is a little bit difficult for I would say, most companies to understand, because it's very different than forwards. You're going to get a forward rate or a non-deliverable forward rate and a US dollar settlement. So what will happen is, if you're going to get a rate and you think that you're going to receive $100,000, you're actually going to, what we call, sell that back. So you had agreed to sell the bank Brazilian real, but on the value date, rather than receiving the real, because you're not allowed to from the restriction, on that value date, they're going to pick a time and an index where you actually will buy that back. The difference is what the bank will pay, so a gain or a loss. So when that Brazilian wire comes over, it's actually converted to US dollars by the Bank of Brazil, and you get your US dollar amount. If it's short, it should be offset very close to the gain you get from your provider. If it's way more because the Brazilian is appreciated, you will get a debit that would offset that gain from your provider. So it's not an exact hedge. The concept is a little bit more difficult to understand because you're going to basically liquidate that forward, and you're going to have two entries that you'll have to net against each other to measure your effective hedge. Currency options, just like equities, is just it gives you the right to buy or sell. We quote a lot of options. We book very few. I would tell everybody that the best time to do an option is if there's uncertainty, like a bid to award. If you have a big contract that you have to put a bid in and you don't know for a while, and there's a lot of volatility, and maybe they don't tell you that you awarded the contract 30 or 60 days, that's a good time to do an option. What we get is transaction hedging. There is some exposure, and they're looking at forwards, but now they want to look at options. And really what happens there is they're trying to participate in the market. So once we get to the treasurer or the CFO and they're talking about options versus forwards, two things always arise. One, when they talk to their audits and their accounting, it is a lot of work that they have to do. So we start talking about hedge accounting, we start talking about effective testing. There's all this infrastructure that goes in to do options, especially when you get into structured products, like putting collars in place or participating forwards. So basically putting a put and a call together to have a range, and then you don't have to pay a premium up front. So when you understand all that, the next thing that we talk about is, well, why are we doing an option? Well, the reason they're doing an option is they want to participate in some of the risk. So maybe they have $5 million in exposure, but they only want to have $1 million in exposure. So that way, if there is a gain in the currency, they make a little more money. Well, once that comes out, they said, you know, we manufacture widgets. We don't play in the currency market. We're not going to do that. If we know that we have a receivable of X amount of euros, we're going to book a forward and we're going to be done with it. Our job is not to play in the currency markets. The forwards are almost exclusively used, I would say, here in the US because it brings predictability in your cash flow, they're accounting friendly, and it eliminates your risk. What we're illustrating here is that this risk matrix talks about if you're unhedged, you do nothing, you have the highest risk. Here are all your other options: plain vanilla, no cost range, 75% participating, 50%, 25%, and forwards. So if you know the exact amount of money that's coming in a foreign currency and you lock in the forward, you have the lowest risk. You know that now that foreign currency risk has been taken away from you and your buyer and put off on the bank. They know the exact amount they need to pay in their local currency. You're going to get the exact amount of US dollars that you would have billed with as a domestic customer. All of these other things just add risk. You might win, you might lose, but really, is this the nature of your business or is it to manufacture widgets? So that's why we see forwards are the most used in this market. All right, so that's a lot of background. What we wanted to do now is go through a case study. The first one I'm going to do is from the side of an importer, just so you can see how your customers are thinking, and then we'll do one from the export side. This is a real life example that just happened, I think, 4 or 5 months ago, but we actually have a manufacturer here in the US. They actually export all over the world, but they are getting some of their inputs from Europe. So quarterly, they have some invoices that come in, and they have always dealt in dollars. It's just been the easiest. They're on QuickBooks. They didn't want to understand markets. They just said, hey, our German manufacturer, can you just quote us in dollars and we'll pay the invoice and we'll pay you on time? Well, in order to take advantage of the dollar strength, we asked them and informed them, hey, we've noticed that you have been importing from the same manufacturer every quarter and paying the same amount of US dollars. So why don't you just ask your vendor, could they provide you that invoice next time in a US dollar price and a euro price? When they did that, the $75 or the euro that they quoted them was 60,240.96. What we did is we figured out that the invoice rate, or basically the rate that they were using to convert euros to dollars to make that invoice, was 1.2450. So they get the invoice and they call us. And what we found out is that it was cheaper for them to pay actually in euros. So as you can see at this time, the euro had dropped 10%. So by paying in US dollars, their supplier was getting a 10% increase in margin. So at the time the invoice due, the market was at 1.1333. I think we all remember when the euro started sliding fairly quickly. They had the invoice of those two amounts. So 75 minus 68,271, they saved a little over $6,700. So literally they got the invoice, they went on their online platform, they quoted the euro amount, they saw it was cheaper, they paid them in euro. That started a conversation with their German counterparty. They said, hey, we do bill in US dollars, our system doesn't work very well, so we're just adding in, I think it was like 12% spread. They'll go to Yahoo Finance, they'll take that rate times 12%, and that's how they were billing them. So now that's opened up a really good discussion from how are they going to price these to make sure that the German company isn't taking it 100%, and neither is the counterpart in the US. They've had a really good relationship for a long time. Now they're sharing the risk and making it a little bit more easy and less stressful for both of them, because right now, the German counterparty would be winning. So the euro goes the other way, it could be the US. So they're going to actively manage their relationship based upon volatility. They're going to set a rate at the beginning of the year so that our customer can import at US dollars. But if it hits a threshold, a ceiling, or a floor, that's when they'll go a different route to be fair to both parties. So here is how we would help an exporter on a transaction that they're billing. So this was a manufacturer of some ag equipment, and they were going to sell into Sweden. In order to win the bid, and this was going to be a large contract for over 5 years, they had to bill in Swedish krona. So they went and had the conversation over in Sweden, and every piece of equipment I think for 18 months that they were going to ship, their price with a built-in margin was going to be $215,000 US dollars. So the price that they put on the invoice was $2,342,500, and they're going to be billing them in 30 days. What they said is, hey, we're going to take this rate, we're going to bill you in Swedish krona right away. Because of the rate, we need you to could move fairly quickly. We need you to pay us in 30 days. So the Swedish company had 100% due in 30 days upon receipt. The internal rate that they came up with themselves, again, I believe, looking at Yahoo with a little bit of buffer, they billed them at $2,343,500. So that is their internal rate or budget rate. When you're hedging, that's something you always want to establish just to kind of know where you're going to value these contracts. So after the conversation happened, they went ahead, they signed the deal. They went to do the first piece of equipment. So to protect that receivable, they said, hey, we're going to book a forward. So they called our desk, and on that day, the rate was actually 10.7350. They knew the payment was due in 30 days. So they said, let's go ahead and book a forward. So again, that's the spot rate. What we were able to do on this transaction is saying, okay, the spot rate is 10.7350. The forward points, so basically to lock in that rate at 30 days, was 0.0173. That gave them the all-in rate of 10.7177. So when we talked about exchange rates, this is the spot rate. It's going to be different from what you see on Yahoo Finance or Bloomberg. The difference between that is what your provider is taking on spread. That is how they're making their revenue. So the forward points is also another opportunity where they will mark up to make additional spread. So this is always a great time that if you're bidding against multiple counterparties, ask for their all-in rate, and that's how you compare people against, because they can take a large spread here and none for your forward points or vice versa. But the executable rate or all-in rate is what you want to know. When they locked this rate in at 10.7177, We agreed that at that rate that was executable, that we were actually going to pay them $218,656.99. So they're actually going to make a little more because of their internal rate. What we should be doing, and what we're doing now after the conversation with their provider, is we could use the forward rate to bill in SEK. If it's a one-off transaction where you don't need to agree to a budget rate that you're going to communicate to your buyer, you can literally call your provider and say, I want to lock in this rate. I need 215,000 US dollars 30 days later. They give you the rate. They tell you, go ahead and invoice them $2,343,500. And what will happen is when that comes in, they'll give you the rate of 10.7177, and you're guaranteed to get the 215. So if you're able to bill on the fly or change your exchange rate, if your exchange rate's not quoting your agreement, it's always great to call your provider, get the forward rate to translate it. Here, they have maintained their 215, guaranteed the cash flow and their margin, and they can move on. Here, they were going to be shipping often and had agreed to a budget rate for a year, so they made a little bit more money. If the market goes against them, they could lose money. So the hedge result on this one here is that the internal price of the company of 215, again, they made a gain of 3,656, so basically almost $3,700. The nice thing about that is this is a gain, it can be a loss. The issue is once they actually billed for it, if they could make the adjustment, they could adjust their price and guarantee their cash flow. But the good thing was once that equipment was going out and once the invoice went out, they didn't have to worry about volatility. It was over. They knew that they were guaranteed that amount of money. So that is how we help customers bill in a foreign currency using forwards to lock in the rate. Either at the time of the invoice, we give you the forward rate to create the foreign amount, or we help you establish a budget rate based upon the average rate, average volatility of the year, and then hedge at a per transaction basis. So that is the majority of what I want to share. Hopefully, we have lots of questions. This one here just talks about the case study. When you're billing in the foreign currency, it allows you, again, to be competitive. It locks in that receivable. I think the most important thing to remember is that your buyer now doesn't have to worry about FX. They're billing in a local currency. They're paying in their normal currency. You don't have to worry about foreign exchange. You're getting your US dollars. The bank is taking on all the risk. It does make it easier on the relationship. It does make you more competitive. It's not as scary as it seems. It can work fairly easy. These are derivatives. So some internal, I would say, considerations that you need to develop is that consider your overall corporate exposure and opportunities. If you don't have any assets overseas, it simplifies your policy. If you're truly just exporting or you're importing on a transaction basis, you really want to establish a foreign exchange policy of what hedging tools are you going to use? Are you going to limit yourself to just FX forwards and FX window forwards? Who's going to do it? And how are you going to measure the success of this policy? You can also decide what amount you would hedge at, what tenor, how long is your exposure. All of those things are something your provider can help you so that if you have a policy, it doesn't happen at the transaction. It takes the emotion out of it and make sure that you're not participating in risk that you don't want to. You're not taking on a risk that you don't need to. And then how often are you looking at that policy, comparing it to the transactions to make sure that it's been effective? And again, if you are bringing in imports, look at dual currency invoicing right now. More than likely, you're going to create a ton of savings. And what I wanted to show you here is this is the problem that our exporters are facing. So the US dollar index shows basically the appreciation of the US dollar versus a basket of currencies, so your major currencies. Our products here in the US are becoming very expensive overseas because of the rapid appreciation of the US dollar. On the flip side, if you turn your hat around and you're an importer, If you're continuing to import in US dollars, you're paying too much. As the US dollar appreciates dramatically, you should be seeing cost savings. So again, it all goes back to managing a relationship with your suppliers and your buyers, having an open and active conversation about how and where FX risk management is going to lie. Is it going to be solely on the buyer, solely on the supplier, or are you going to agree to a budget rate, have thresholds where you renegotiate price? All these things are best to have before these events happen. So that way, again, it takes the emotion out of it and it doesn't put strain on the relationship. All right. So that is what I had from the presentation. Are there any questions? So more than happy to talk about or answer any questions regarding foreign exchange, hedging, spreads, pretty much open to anything.
Michael, we had one question previously, but I went ahead and answered it. Basically, the question was, are there any countries, not companies, countries that deal in dollars only? And my response was that, no, I mean, there's no country that deal in dollars only. I mean, that's a company decision, not a country decision.
Yeah, so the US dollar obviously is a very global currency. There are some countries that you do need to interact with in US dollars. So China, Brazil, and some of these others. And the reason for that is because even though in Brazil they're trading and they're using the Brazilian real, they are going to restrict the real coming out of the country. So today I can make payments to beneficiaries in Brazilian real, not a problem. But the Brazilian country, or basically the central bank, will not let the real come out. So there are some that you have to do. The other thing I can say is if you're in the ag business or you're working with commodities, they're going to want US dollars. So if you're a prime example, we export a ton of beef to Korea and Vietnam. We could do the local currency, but the beef price is tied to US dollar. So that creates another exposure. So the two times where we see it's less effective to do some of these is restricted currency. That's where you do the non-deliverable forwards. We see a lot of that if you have a ton of exposure in those currencies. The one thing I would tell you is if the currency is restricted, doesn't mean you need to do a non-deliverable forward. Until recently, China, we didn't want to do non-deliverable forwards because their currency didn't have a lot of volatility and it restricts the amount it can float. So that's something you have to really lead on your provider. And make sure, again, I always tell everybody, when you're talking to your provider, first ask them what spread they're charging you. If they're going to be upfront and tell you how much spread they're taking, you've got a great partner. If they're not going to give you a right answer, maybe not. Again, we don't want to sell derivative products, non-deliverable forwards to certain countries because they're pegged to the dollar. I can do it, but the cost that I'm charging, probably more than the volatility. And again, the second thing is if it's commodity-based products, like corn, beef, and wheat, well, they're probably hedging that cost on their own in US dollars. So they've got a natural hedge in place. So it makes sense to bill them in US dollars. And frankly, they probably will tell you, I'm not going to pay you in anything but US dollars because I've got it hedged. And that would be on exchange.
I do want to touch on one point that you made, Michael, and I implore you, if you are looking to do currency exchange, please don't just go to Yahoo Finance. We've actually seen that done here, and I highly recommend you get a professional to give you an accurate quote.
Yes, I provide foreign exchange services to about 382 financial institutions. Most of them are regional or community banks, and I give them all the same script. So the rate that you see there is not executable. That's an interbank rate at that time. So when I am out buying 50 million euro, I'm getting that rate or maybe one tick higher. If you're with a community bank, more than likely they're going through a larger bank or another provider, and they're all taking spreads. So if you actually are using for a budget rate, that might work. But if you're using it to actually bill or to actually convert, expecting cash flow on that, call your bank. They should be able to give you a rate. And if it's a one-off transaction, and they get close, it's great. But if you have a repeat and they are not able to give you a rate, then that's when you need to find a provider that can help you with foreign exchange.
Okay. Now, I think, Heidi, you've indicated there's a question in the chat. It says, do you have a list of those countries like China and Brazil where US dollar transactions are mandatory?
We could help provide that. I can send that to Heidi. So we've got a list of restricted currencies. So we're a little bit different. We have a full trading operation here in Omaha. So we trade in 109 currencies in 182 countries. What I can do is the most commonly 35 I can send. These are very liquid and forwards. I'll send up I'll break it down to two lists here where you can buy forwards and hedge, which are very liquid with just about any provider. And then here are the countries that are dollar based. We can definitely do that for you. So it looks like Eddie asked, is your fee the same for a small company versus a big company? Yes. So one thing I will tell you is that, again, in the foreign exchange market, a lot of banks try to be overly sophisticated. We're not doing anything really that crazy. You're going to give me one currency, I'm going to give you another, and we're not going to overcomplicate it with bundling products together. So a transaction fee, I will tell you on foreign exchange, usually is somewhere between 15 to 40. If it's higher, it's because they're going through another bank and they have to make fee income. Your spreads are always going to be tiered. So that's why you want to talk to your provider. And the more that you do, so if you do a transaction at 5,000, you're going to get a better rate if you did a 5 million, right? What we're trying to do as a community is say, let's not look at a transaction basis. Let's look at the relationship of how much foreign currency you do, and let's price it off that. So it's all by volume, but there's I would say it's called the FX Code of Conduct. What we're really trying to do as a community, part of NADEC, I'm on BAFT, I'm the chair of the North American FX Forum, is saying, what is acceptable spreads? Because what we really see is that small banks have to use providers. There's spreads that are getting provided to them that just really aren't competitive. And anything really, I tell anybody, over 3.5% is just users and unfair. So our average book is somewhere around, I think, 155 basis points. And we have a ton of customers that are doing transactions at 3,000. Now, we do have customers that are doing multi-million-dollar transactions, but that's not the bulk. The ones that are actively managing their FX are at the lower level or small to medium-sized businesses, because those small transactions mean a lot to their cash flow. So as your volume goes up, they should waive your transaction fees. And your spread should come down.
Rudy, you're on mute, Rudy.
My apologies. Thank you so much for that. I don't think that we have any.
There's actually one more in the Q&A section.
Yeah, one just popped up. Is there a baseline minimum amount as a U.S. exporter ought to look at doing this instead of just selling in U.S. dollars? And I'll repeat the question. Is there a baseline minimum amount a U.S. exporter ought to look at doing this instead of just selling U.S. dollars?
Yeah, it really depends on your relationship. So I always tell our clients that if you're going to build a relationship where there's going to be multiple shipments, that's when you should really look at it. If you're just going to do a couple orders at 10,000, maybe 2 invoices at 10,000 USD, probably not a big issue. But it's really different. I have a customer that we built their policy. They said anything under 500,000, we're not going to hedge. I have an exporter now that basically I think they're invoicing at 35,000 and they have to give 35,000 euros. They have to give 60 days. So they were told they have to do euros to keep the business. And 60 days is a lot of money to them, so they're hedging. So I would say if you've got a really good product and you have no competition and people are going to pay you in US dollars in cash advance, I mean, that's the unicorn. The issue is if you're losing sales to competitors because they're doing it in foreign currency, that's when you need to do it. And if it's 20,000 USD and that's meaningful to you, then I would do it.
All right. I don't see any other questions at this point. Michael, thank you so much for sharing your expertise with us. A fantastic class, lots of great information. And Ms. Heidi, if you would put up the slide that has all the contact information. Oh, yeah. So we have a class coming up on December 7th, doing business in Canada. It's likely going to be from 9 to 10, but we haven't determined that yet. So just kind of be aware that that's coming up. And if you would put up the slide with the contact information, would appreciate that. There is Michael's email address. I'm sure that you guys will, as you think about this and look at the information, you'll come up with some additional scenarios that you can discuss with Mike. So there is his contact information. There's my information as well as Heidi's. If you need anything else from us, please feel free to contact us. Jonathan, any last words?
Yeah, I just ask for you guys to, join us on the December 7th for the Doing Business in Canada. That's probably one of our top webinars because it is the top country for Arkansas exports. It's probably the most user-friendly and the easiest market to get into, whether you're new to exporting or already have exports going to other countries. So join us for that. Michael, thank you for being here and giving us your expertise. And Rudy, thanks as always for being the driving force behind the education.
I appreciate that. Ms. Heidi, are we going to have a survey that we'd like to ask the participants to respond to? Huh. Okay. Well, you may be receiving a survey. Yes. The only way that we know whether we're doing a good job is to hear back from you guys. Look, Ms. Heidi, looks like you're on hook now. Is there going to be a survey today?
Yes. I will put that in the chat shortly here.
Okay. And once again, we really would appreciate you responding to it at your earliest opportunity. That way we have feedback and perhaps some ideas about things that we can do differently and do better to better serve you.
There you go. There it is. Please answer the survey. Thank you.
Thank you again. All right, ladies and gentlemen, thank you again. Michael, thank you. Jonathan and Ms. Heidi, thank you for participating, and we will see you later.
Thank you. Have a great day.
Bye-bye.